Hi, everybody. Thanks for joining us. A little bonus material this week. Should I buy the dip? The market's been recovering a little bit, and this tends to be a big question. So let's kind of talk about how to make a decision on things like that. You've got two sides of it, speculative, and then should I really be doing stuff like this? Okay. So the speculative side of this, people are, buy low, sell high. It's real simple. And so the first question you're asking yourself, is this the bottom, or is this one of those false bottoms? Look, we've seen some huge swings in our market, and they've been very definitive in hindsight. But when you're in them, it doesn't always make it as clear. So we do have to be careful about the speculative side of it, which means we need to kind of look at our own situation and make sure that it's right for you, and then define how much of our portfolio we should be playing around with in that type of investing structure. So let's be careful about this as we kind of look through our choices on this. The best part is really looking at history, because it makes it so easy. We had 9/11. Where was the bottom there again? We had 3 years of double digits going down and down and down. So when you talk about buying the dip, a lot of people, come up with their own criteria. Heard lots of theories, and every time it goes down 10%, throw money in. So that way, if it goes down 40%, do you have 4 chunks of money? And how many chunks do you need to be prepared for? If the market goes up for, look at this. If the market goes up for almost 10 years straight, you have no entry point and you missed out on all that growth. So we gotta kind of look at this situationally. If you imminently have some cash laying around and you're seeing some big movement, sure, hang out, wait, see what's going on. But if you're just sitting around waiting for the market to fall before you go in, define it first of all, and also define how long you're going to wait. Because if you're waiting for it to fall and it just keeps going up and up and up, it kind of causes a problem, and you're going to miss out on all the growth that you would have had just by investing it right away. So historically, there's plenty of metrics to look back and just say invest it right away, regardless of where the market is, or situationally look for a quick little pullback and then throw it in, but don't wait long. That's the big part of this. You can't sit around on the sidelines for 5 years, 10 years. Anything more than a year, and boy, you're really missing out on a lot of growth historically. So, 2008 had a very defined downward movement, but here's the thing. Let's find 2008. Here it is, right here. So we've got 2008 right here that had a very defined downward movement, and then when it started coming back, it didn't stop coming back. We had a little falter in 2010, but not much. A little falter in 2011, 12, not much. 2016, 15, 16, a little bit of faltering, but again, not much. Kind of look back at 2008, doesn't really seem like a big, crazy, painful movement, does it? Especially where we're at today, right? The pandemic crunch is right here. That was a wicked fast movement down and then straight back up. But, boy, beginning 2022, just kind of slowly slid and slid and slid. It didn't seem to be a straight panic down, but it sure looks bigger on a chart. The grand scheme of things is, if you were waiting and waiting and waiting, you waited through a lot of growth. And that's what we don't want to find ourselves doing. Okay, so buy the dip. Well, if you've got some imminent money and you're trying to get it in at the right time, great. You want to wait a month or so and try to figure out if this is the bottom. Wonderful. But what if we continue straight up? Okay, or what if you buy and, oh yeah, we're not doing so good, and we fall back down? Trying to predict the market means a crystal ball, and that crystal ball is not the best way to invest your money. It gets way too emotional. So from a structural standpoint, then we have to move into looking at what's right for some people and what's right for other people. Okay, not everybody should invest the same way. No one can tell me that their buying the dip strategy should happen with all their money and you should be all in on it. Okay, so we have to first define what part of life we're in. Okay, and this is not age-based. Savings and growth years. I know retirees still in savings and growth years. Okay, so these are defined by people that spend less than they make. Okay, so they're still saving. And typically, what's most efficient for people in these years is automating that savings, getting it in fast. That's what 401ks are for. Every paycheck, they're taking some money out, throwing it in the market. Okay, then it's all about investing as efficiently as possible, reducing fees. Keep an eye on those fees in those mutual funds, in those 401ks. And if some slick advisor comes in and says, hey, we'll pick those mutual funds for you for a small nominal fee, please, there's no reason for that. Okay, there's no reason for that. Broad general market investing is the best in your younger years. It's all about automating that savings and knocking out as much of the fees as you can in those years. Okay, keep saving through turbulence. This is a big part of this. Put your blinders on. Don't watch for turbulence, just keep putting in consistently. That helps you dollar cost average. When the market's going down, you're buying more shares cheaper. So when it's coming up, you have more shares, each individually growing. You break even and your growth is explosive after you're breaking even, okay? Then there's the preservation years. These are the people that are spending what they make, okay? We don't really need the savings unless there's an emergency or maybe a big vacation, just the occasional little bit of money here and there, okay? So safe investments become the core of the portfolio unless, this is a big unless, your goal is to make sure as much of this wealth is passed to your heirs. So this is where that part of it changes how you're going to invest. If this money is there for your needs, for your emergencies, for your fun, then you want to have safe investments that you can pull from when the market's not doing well. Okay, so they should be the core of the portfolio, typically over 50% of the savings. Okay, these are typically people that are heading towards retirement. Okay, so, or in the early years of retirement and they're kind of feeling things out. But the bottom line is they don't need that savings to fund their basic living expenses, okay? And then there's the weather the storm through the turbulence. Just make sure you're not pulling from investments that are down. I have a little mini class on that on the YouTube page as well. Then there's the spending years. Most of you in retirement are in your spending years. Some of you don't spend your money, but you should be, and you want to be, and you aspire to be. It was the whole reason you saved through your life was so you could enjoy your retirement spending some of that money. Okay, so it's not easy. You flip a switch and you're supposed to go from spending less than you make to spending more than you make. That's where the planning comes in and it really helps. Okay, so make sure that you understand your financial situation. I talk a lot about that in a lot of our classes, and really it's doing that budget and understanding what your base living expenses are. So that way we realize how much of our savings we can actually use year to year, give ourselves that budget and go enjoy. Okay, so the rules that you have to live by in your spending years: the greater your withdrawal rate, the greater the effect of turbulence. So for instance, Warren Buffett goes to McDonald's for his $1 breakfast. He has billions of dollars and he needs $1 to spend that day. He spends very little of his savings, so turbulence doesn't bother him at all. Okay, so the way he invests may be different than the way we invest. He's a big proponent of buying when everybody else is freaking out and selling. Okay, that's kind of that buy low, sell high theory. Okay, it's just a little different twist on it. Should I buy the dip? Well, he's always going to say, yeah, when everybody else is selling, I'm there buying. And there's nothing wrong with that. He tends to buy a lot on sale, but he also has bajillions of dollars, and he's never all in, all out, all in, all out. Okay. So he has his defined portions of his portfolio that he's doing that. So the other side of this is the efficiency side. Okay. Understand that in retirement, your goal is reduce fees, increase your tax efficiency and your investing efficiency. Remember, reducing the taxation that you pay can save you lots of money in retirement. And so having advisors that actually understand taxation becomes really important, especially ones that are free to talk to you about it. I hear all too often that somebody's not allowed to talk about taxation. And in broad strokes, when it comes to financial planning, absolutely unequivocally, you should be able to talk about it, because every decision, every investment choice causes different taxation. Then there's those transfer years. Okay. Once you start realizing you're not going to spend all your money, okay, then you start looking at, how do I transition it to my heirs? And that's where you start defining what you could possibly need for yourself and start investing for your heirs. Okay. So how does this affect the choice of buy the dip? Well, the big part of this is understanding the position of your portfolio. So this modeling is taught in the CFP. These are statisticians that created each one of these three lines here. They've come up with black and white proof on how to defend all the big boys in court of law should you complain that they've mismanaged your portfolio. So traditionally, and in the Certified Financial Planner book and education, it's just an age bar down here. And I've 100% disagreed with the age bar, because when it comes to the relevance of every individual person, the age bar doesn't work. Not everyone is the same. Again, I go back to Warren Buffett. Warren Buffett's, I think, in his 90s now. Should he have no more than 40% of his money in stocks? No. He's in a completely different situation than everybody else. And I actually know lots of retirees that I call Warren Buffett's. And it's because their income pays all their bills and their fund, and they don't really need their savings. Okay? They're in very enviable positions. And that doesn't mean they're rich. That means they're in very enviable positions. I know people that make $3,000 a month and live extremely happy lives on under $3,000 a month. So all their savings is there for their heirs. I ask them to spend it, and they say, I don't know what to spend it on. I enjoy my retirement. So everybody has a different version of retirement. So when we look at this spectrum, I want people to understand that the whole idea of this chart on the left-hand side is how much of your portfolio should be in risk-based investments and turbulent investments, investments that you're allowed to lose, the stock market, okay? So you will go up and down on this portion of your portfolio. And instead of the age range down at the bottom here, I put, do you need your money? Because that's really what the heart of the situation is when it comes to building someone's portfolio and deciding how much we should be in and out of the market and playing with the market. Okay. So if you really need your money, then less money you should be speculating with. Okay. If you're just starting out and you're an aggressive investor, I know my nephew was constantly going after individual stocks that he thought would skyrocket, things like that. So younger people tend to have more trust in the market and haven't had the experiences that most of us have had in the market. Okay. So if you don't need your money, you can weather the storm. You can wait for that downturn to buy the dip. Okay. You can do it all in, all out. You probably shouldn't, but you can. You have the ability to in the structure of your situation. Okay. So if you're still saving, invest annually at minimum. Okay. I want to put that structure on it. If you want to sit around and wait for movements, great. I don't have a problem with that. If you want to accumulate cash, But if you just sit out waiting for a dip in the market and it just continues up and up and up for a 5-year run, a 10-year run, even a 2-year run, you missed out on all that growth. And that is not efficient. And it shows through history that is a terrible idea. So if you look at each year and just decide when you want to get in, hey, I'm fine with that. A little turbulence here and there. You want to just wait a week or so and see the market come back a little bit. Great. I don't have a problem with that. If you see big movements and you want to kind of wait till you decide where to enter the market, that's great. But I also can tell you at the pandemic crash that we saw, it was extremely definitive. It went straight down and straight up. But everybody was looking around, and I talked to lots of people. As the market went straight down and started going straight up, we all kept saying, is this the end? And I kept taking a quarter of my portfolio and putting it in, dollar cost averaging it back in. But the reality is not everybody can do that. Okay? Not everybody, one, can stomach it. Number two, from an emotional standpoint with their own money, can think through that and decide, is this the bottom? This can't be the bottom. The pandemic is a great example of that. We had another 1.5 to 2 years to deal with this pandemic. Why is the market still going straight up? We always thought that this was going to come back down, and it never did. Well, it kind of did this year, but not really. Okay, so bigger movements, dollar cost average in. Ease. You don't know where that bottom is. When you decide, put a little bit of it in, then put a little more in and a little more in. Okay, ease yourself back in on the big pandemic, 9/11, 2008, all the big, huge movements that we've had in our markets. Everybody else, okay, everybody else, define the proper allocation. You know, we have this conversation with people that have more money than they need for themselves. Define how much it is that you can play with. You want to invest in private investments. You want to have your own little speculative portfolio where you're buying that individual biotech stock that you think is going to shoot to the moon. Fine. I don't have a problem with that as long as we define the amount of money that we're going to play with. It's kind of like going to the casino with a blank check and you can write out as much as you want. It's probably not a good idea. Some of us can handle that. Some of us should never even tempt ourselves with that. Okay, so define the proper allocation. If you need your money in retirement, define which part of your portfolio is needed to be in safe investments and what should be in the market. And then what's the reality of it is instead of this all in, all out with that portion, we might want to kind of look at it as an ebb and a flow. Maybe 10% leaning each way. Hey, the market just tanked. Okay, maybe we should reach in and grab some of our safe investments and lean back to the market for the next few years. Great idea. I don't have a problem with that. And especially in retirement, it's an ebb and a flow, not a speculative all in, all out. Okay, we need to have structure and stability in our portfolio so we can go enjoy retirement, not live on pins and needles. Okay, we need to have safe investments that we can access to take advantage of these types of movements. But again, it's an ebb and a flow, not an all in and all out. I'm scared of the market. I want to be out of the market. I want to be back in the market. That's emotional investing, and that's going to lead into huge problems in retirement. So you define what's right for you. And if you want to ebb and flow 10% here and there, I don't have a problem with it. That's actually a good idea that takes advantage of the market. But building the portfolio that's right for you, if you have 40% of your money in the market, you should be okay with 40% of your money going like this if you have good, safe investments that aren't losing a penny. And by the way, bonds have not been that safe investment this year for sure. And as interest rates rise, the value of bonds continue downward. So if you're going to stay in bonds, understand that will be a downside to your portfolio if interest rates continue to rise. Okay. So the point of all this is really just discussing and understanding everybody's in an individual situation. For retirees, define what the right portfolio is for you, and ebb and flow 10% or so back and forth if there's big movements in the market. You want to do it every time there's a little 10% pullback? Yeah, that's a lot of work on your portfolio for historically not really a proven track record. Okay. Invest the way it's right for you, for your situation. Ebb and flow. People that are still in their wealth building years, I typically say more than 5 to 10 years from needing your money, you can do whatever you want. But I just tell you, statistically and historically, please don't sit on the sidelines waiting for your opportunities to put in, waiting for that pullback. It's more opportunistic than anything else. If you're in your savings years and you want to accumulate cash and then dump it all in once a year, great, but don't wait more than a year. Okay? Be very careful about that, because sitting on the sidelines has absolutely, unequivocally, black and white, proved to be the wrong decision when it came to the market. Timing it is not easy. You want a dollar cost average in after a big movement, great. You know, the pandemic, a lot of people were real good at selling their portfolios. A lot of people, hey, look, this is obvious. It's going to go down for a while. Let's pull out. Some people rode right through it and did just fine, came right back. Okay. So just understand, if you're going to pull out, you've got to make sure that you're ready to put back in and have a strategy for that. Buying the dip, it's right for some. Statistically, it's been a nightmare for a lot of people. Hey, thanks again. If we can help in any way, shoot us an email or give us a call anytime. We're always happy to help nationwide via Zoom or in person here in Arizona, in Scottsdale or Prescott. If you like our videos, that helps us out a lot. Subscribe below if you haven't already, and certainly share with your friends and let other people know about the education we're putting up here for everybody. Thanks again. See you soon.